Welcome back, friends. So we have the US markets and the global markets on a reasonably sound footing as they begin the year 2023. FTSE is at an all-time high. The US markets have also done reasonably well so far. The US economy is on a sound footing if you go by the data that is getting released from time to time. And the unemployment rate is also super low. Yet you find that new cracks are beginning to appear. A rising number of Americans are falling behind on their car payments. Some 9.3% of the auto loans extended to people with low credit scores were 30 or more days behind on payments at the end of last year. This is the highest since 2010, according to an analysis by Moody's Analytics. The past few years, of course, as you know, have been unusually good for the consumers. They've not only been stowing away the extra money during the pandemic, they've been getting a lot of giveaways, throwaways, as you would like to call it. But sky-high inflation is now beginning to eat into those gains. This combined with the market, which last year was not that great, okay, it's just marginally higher this year, is beginning to eat into the savings of people. And last year, many people had witnessed a very big rise in the car prices on account of a shortage of vehicles. That was a supply shortage. So many borrowers took out large loans to buy them. And to the extent that they had left very little of cushion should the economy hit a rough patch. The households that were on the financial ledge to begin with might have been tipped to the point where it's getting hard to keep up on the car loan and other loans as well. And people have to make some very hard decisions. Okay. Stress in the auto loan market is concentrated among borrowers with credit scores below 660 and is especially high amongst people with bottom of the barrel credit. But the stress could spread if the US goes into a recession, and I believe they will. Okay. So if job losses increases, then many more consumers might find themselves unable to keep up with this record amounts of debt which they've taken in the recent years. This combined with the increasing the mortgage credit costs because of rising interest rates, and I think interest rates are going to rise some more. So all this is going to raise questions, and more cracks are going to begin to appear as we go down the road. So if people think that we have reached a stage of low interest rates, Goldilocks scenario as they call it, low interest rates, and earnings are going to start improving, whatever interest rates had to rise have risen, Fed is going to start cutting interest rates shortly, all this scenario, this is, I think, far-fetched and is not going to materialize. We are beginning to see new cracks appear in the global stocks, and that's going to come and haunt stocks sooner rather than later. We have from a research figured out that exact time periods where it will hit you the most. And to get to know more about the Indian markets, please do join Premium or Premium Plus. And to know more about the US markets, please do join Prime or Prime Plus. Number to get in touch, 982-086-1044. You can alternatively also email us at globalmoneyinvestor@gmail.com. globalmoneyinvestor@gmail.com. Yes, we have a policy of rewarding the people who have been with us the longest, and who have been continuously with us. We will definitely try and give them all this information as much in advance as possible. But yes, you can also join and be a beneficiary of some very precious and priceless information about where the big turns in the market are coming, and there are huge turns coming in 2023. Happy investing. Take care. Bye-bye.